Well, you heard it moments ago. Joe Grano warning that whichever candidate wins the White House, we could be facing a big post-election sell-off in equities.
Let's get reaction now and some ideas, more importantly, of what to do with your money with Walker's Global Managing Partner Ingrid Pierce and Bank of America's Global Wealth and Investment Management Division CIO Chris Hyzy. Great to see both of you. Okay, Chris, people want ideas, but first let's get your reaction. Do you agree with Joe Grano that we would see a 10 to 20% correction in the wake of the election?
Well, I guess anything's possible. We've seen it all, really, since the collapse of Lehman, which, was about eight years or so ago.
Well, maybe the better question is, would you sell on that? Would you panic on that? I know you're not a guy who panics, but is it simply just a little bit of a speed bump?
If you go back to January and February, we had a 16–17% correction. And to me, that's close enough to a 20% correction, which you typically get in bull markets, and then you re-advance. Or at least you get a few of those, like we saw in the 1990s. That was driven by four fundamental fears. Right now, we don't have a real fundamental fear. We're all still climbing the wall of worry on negative interest rates, the elections, rise of global populism, a whole number of things. But the real reason back in January and February was the strength of the dollar. 25% move over the course of 18 months from 14 all the way through 15. And people weren't ready for that. When I say people, that's corporations, governments, exports, et cetera. Can that happen between now and the elections? I don't see it. Could a correction happen 10 to 20% because of something out of the blue? Plus the worries over the election? It could. I think it's a very low probability. And investors should be buying that pullback, because we're going to continue to inch forward with 2% growth, 3% growth, and no yield in the world. And the equity markets, dare I say, there is no other alternative, is the area of choice.
Ingrid, your clients are looking at technology. If we do get this correction that Joe Grano has forecast here, where should investors be thinking long term?
Yeah, well, they've got to look at some alternatives, because at the moment, as we're talking about, the yields are very low and there's not a lot to be gained either in traditional investments or in cash. So people are looking more at alternatives. So we're seeing quite a lot in the private equity space, in the hedge fund space. Even though performance has been down, that's still where people are allocating. They've got to have a portion of their capital put into some kind of alternative structure, even just for diversification reasons. So, tech, yes. One thing that's been interesting to see is that's really gone on the rise, not just in the VC space, but some of the bigger asset managers are now looking to put some capital into some of those new industries. So fintech, for example, but also actual real technology, with people investing in alternative energy sources, some of the automated vehicles and that sort of thing. They're really starting to get a bit of an edge now, and it's rising more than we actually thought it would. So some of the energy stocks and the other traditional asset classes, no. The other thing we've been seeing is a bit more on real estate, which is kind of surprising perhaps in this market, but there's been rebounds in a few pockets, particularly in the US, and we think people are still going to invest in that sector.
Some of these alternatives might have a long runway before you actually see financial liftoff and payoff there. But Chris, what do you see as sort of that best opportunity out there? You mentioned equities, but narrow that down for viewers watching right now.
Well, I think first off, I think most people should really take a step back. You think about asset allocation in general. A risk-neutral, balanced approach right now, which is a very fancy way to say be as diversified as you can through the back half of the cycle. The economic sensitive areas should start to have that improvement factor take over. Some of the financials should start to actually benefit from a Fed who wants to see that window open. All of the rhetoric coming out of the Federal Reserve right now is let that window open so we can bump rates. It happened in this week as well with Mario Draghi's speech, not advancing QE, or at least extending it. So the central bankers around the world want to see a bump up in rates for a variety of reasons. But when you take a look at the actual real ideas within the equity markets, it's the areas of dividend growth. They're not overvalued.
Some say that's an overcrowded trade.
It's overcrowded at the higher yield level.
Okay.
You look at retail flows, you look at a very, very significant movement into some of the ETFs, absolutely. And that's where you get those utilities that trade at 25 times earnings or something like that with a growth level of 5%. That's overvalued. But right in the middle child syndrome is the dividend growth areas of the marketplace, where any fund manager can buy those. You can get the value folks, you can get the growth folks, you can get the high quality, you can get the lower quality, and that begets a big opportunity.
Ingrid, a lot of investors have reached to high yield. High yield has been a great performer, despite the fact that many people have come on this show Carl Icahn, Jeffrey Gundlach, and warned about it.
Said stay away.
Yeah, and said stay away because they're looking at obviously where the yields are and they're looking at what the potential concerns are given the credit exposure.
Yeah.
What do you tell investors that have been buying junk bonds this year?
Well, that's a very dangerous space to play in. I mean, people who have made a lot of money doing that, yes, but people have lost their shirts on it too. So what we're seeing is actually more people looking to diversify. Perhaps some of the credit is really where we're seeing more people actually put their money, so a lot of private credit, and is an alternative lending source because, of course, the traditional banks can't lend at any meaningful rates.
Viewers of this program, if they want to get exposure to that sort of leverage loan business that you're talking about, direct lending as opposed to buying an ETF and a junk bond fund, how do they do that?
They need to get onto a platform. So depending on what the sort of asset capital is, I mean, you can invest in some of these directly through particular managers that are specializing in direct credit.
Right.
Otherwise, you have to get on a platform with a bank or somebody else that's actually doing that and allowing people to come in at lower initial investments capital.
Chris, what would you absolutely avoid right now?
The lowest of low quality in the high yield space. I still think you're going to see a lot of companies having difficulty refinancing at these particular rates, but more importantly at where we are in oil prices. So if you look at the energy, the very, very low quality end of the high yield area there's a lot of energy companies in that simply are not going to be positioned for the future of where oil prices are or where they're going. So that's one area. The other area is the really overvalued spectrum, again, of the equity market that is going to give you a yield of, say, 4.5%, but is trading at 25 times earnings.
Too expensive.
Too expensive. Much too expensive.
Good.
Great to have you guys. Thank you so much. Our thanks to Ingrid and Chris. It's lovely to have you. We are going to be right back.